And good morning. Rain has finally stopped in Houston. It is Thursday. We are the Price Group, and we are here with another one of our continuing educational events. Today, we're talking about creating income for retirement. The old saying, mailbox money is indeed good money. And so we'll be talking about mailbox money this morning. So welcome, glad you're with us. Train's running on time. This should be about 35 to 40 minutes. If you have questions, comments, there'll be a opportunity there at the bottom to raise your hand and ask a question. And let's get started on how do you create income for a successful retirement. So who are we? Again, we are the Price Group, family owned and operated. Six people here on our team, 50 plus years of experience. The most important thing for each of you is that we are a fiduciary. May sound like a legal term, which it is, but it means that we sit on the same side of the table. We make decisions in your best interest, and we think that is critically important, especially as you get toward retirement. This is exactly what we do. 80+% of the folks that come to us are retired within 5 years of retirement. We love what we do. And again, we will tell you a little bit about our process and what goes in to creating income for retirement. Myself, Matt Price will join us on this webinar, and also Maddie Kearns on the team.
So a little bit more about us. Maddie, Randy, myself, both certified financial planners. Randy mentioned we followed a fiduciary standard. We think that's probably the most important thing about our team. We've been humbled to get a few awards from Forbes. Randy has awards from Barron's, Financial Times, and anyways, hopefully you're following along on our email, what we call the Retirement Insider, a weekly insight email. If not, shoot us an email. You can find out how to sign up online on our website. But we try to push out a lot of educational content on a regular and reoccurring basis, looking to over-communicate, especially when markets do get choppy. Our firm, Steward Partners, based off the biblical definition of stewardship. Raymond James is our primary custodial option. Custodian just means where client assets are held. Pershing is the other one. Both Raymond James and Steward Partners have been great partners for us. Clients really like the technology, the interface that we offer, just logging in online portal. And we'll talk a little bit more about our Live Well plan and how clients can utilize that tool on their own. But today, here's what we're going to do. We're going to warm up our brain, get everyone kind of going. A quick review of markets, not necessarily specific to now, but just more thematically. And we look past over the last, call it 100, 125 years. The top 5 risks of retirement, how producing income can help mitigate these risks, and then what we think is important to live well in retirement. But before we start, there's probably a dozen, maybe 2 dozen reasons why you attended this webinar, worried if money is going to run out in retirement. You want to avoid mistakes. How do we generate income? The list goes on. We can say this, everyone we've talked to at the station of life as they approach retirement or they're newly retired, they're looking for the 3 C's: clarity, comfort, and confidence. And so our goal today is we want to hopefully take a step towards that. Now, a general presentation like this, it doesn't take you to the finish line, but hopefully this makes you think about a few things maybe you haven't thought of. And our goal is to, if you're interested, hopefully roll up our sleeves and help you put together what we call our Live Well plan, if you find any of this information interesting.
So let's warm up your brain with a couple of questions, and then we'll get into the meat of the matter. The annualized total return for the 500 largest stocks, the S&P 500 index, in the decade of the 1930s. Remember what happened in the 1930s? We had a very difficult economic period for the United States, and the answer is 0%. So you left for 10 years, you came back, your account had not changed in value. The global events of a time will in fact influence the stock market, as we're more aware of even now. But let's let's go ahead and get started as far as a market overview. One of the famous people that are often quoted for slogans, it's tough to make predictions, especially about the future. That would be a yogi-ism, but this to us is a very interesting chart, perhaps a little bit busy, but it takes a look at a long period of time, 120 plus years, of bull and bear markets. Bull markets, when the market goes higher, we all like bull markets. Bear markets, where the market goes lower, the old adage of been getting eaten by the bear, are in the red here, where market has gone lower. And what you can see here, again, secular comes from the Latin word meaning a long period of time, but bull and bear markets tend to last for numerous years. And so you can see there the bear market we point out there 1973 to 81, the market went up and down but didn't go anywhere. And we've been in a period that some people would call bull, with a little bit of a bear there for the COVID pause that we had, where things really went south. But anyway, through June the 30th, 2023, where we've plotted there, we still think we're in a bull market, obviously subject to change, and can go on for a long period of time. Perspective of where we are. Now, as a lot of people get closer to retirement, they think about, as we go to the next slide there, they think about investing in safe fixed income or safe bonds, a corporate bond, a government bond, a tax-free municipal bond, or this sort of thing. This, I think, is again, good perspective information. 1928 to 1940, you retired and you were invested in treasury bonds. Well, hey, you did really well. 5.6% on the treasury bonds, 1941 to 1960. Obviously, what happened? We had some inflation. The World War was going on during the 40s, and you invested the same way, and you had a negative real rate of return after inflation. Okay, real means you take your rate of return, you subtract inflation. If you make 5% and inflation 6%, you have a negative 1% real rate of return, because goods and services cost more. 1961 to 1980 was not a good time either to invest in treasury bonds. And then voila, interest rates were very high at the beginning of the 1980s. They continued for a long period of time lower, and you did very well in fixed income. Your treasury bond yielded on a real rate of return 7.4%. You didn't take the risk investing in the stock market, and you did very well. So it's 2001 to 2022, again, a different period, a different answer, a different rate of return. The treasury bond has been very muted, 1.3%. Most people find it very difficult to live with earning 1% of your money. So what does this teach us? It teaches us that inflation can be really, really dangerous. It can be really, really harmful. And it teaches us that there are periods where you need to do more than buy and hold. And that's where a process comes in. That's where being tactical, a little bit of an Army term there, of changing the way you manage your, especially here in this slide, fixed income. But that's what we are all about with regards to putting together our Live Well plan. That's what we think is so very important, by having a process to invest in stocks, and also a process to understand and invest in fixed income. So what are your 5 top risks of retirement? Number 1, longevity, living too long, if you will, for the amount of money that you have saved. If you're 65-year-old in good health, living to, you can see there on the left, age 75, 85, 90. The average male lives 21%, live to 90, female 33%, but a couple 47% chance that one spouse will live to age 90 or beyond. So your money's got to last, and your money needs to, again, adjust for inflation over time.
So our takeaway here is, when planning for retirement, don't just use life expectancy. We want to go past life expectancy, because life expectancy includes people passing away in their teens, their 20s, their 30s, etc. The old saying, the longer you live, the longer you're expected to live, we think is really true when doing retirement planning. Retirement risk number 2, inflation. We think inflation, we call it a hidden tax in retirement. What we're illustrating here is the rule of 72. So what this means is take the number 72 and divide it by your inflation rate, and it will tell you how long it takes your cost of living to double. So at a 3% inflation rate, 72 divided by 3 is 24. Your cost of living is doubling every 24 years. Now, what if inflation clicked up to 6? Well, your cost of living will double every 12 years. So inflation really is a hidden tax. We need to make sure that we do include that when you are looking at these retirement assumptions. But we also need a strategy with your investments that can mitigate this inflation. We'll talk about that in a little more detail. And we think historically what may have worked is probably not going to work as well moving forward, just in some traditional bonds. But we want investments that can offset inflation. And this is not an annuity commercial where we're trying to sell you an annuity, but we need something that can offset this income for your pending or current retirement. The third risk, market performance, or we call this sequence of returns. This is a little more granular. Let's see if we can do this at a high level. There's 4 boxes here. Let's look at the 2 boxes on the left. The 2 boxes on the left are pre-retirement. So what we're looking at here is a assumption that you start with $100,000 over a 10-year period. You're getting a 7% return every year. Now, in the top left-hand box, that first year, you're getting a negative 15%. You can see years 2 through 9, you have a 7% rate of return, and then you have your best year and your 10th year of 29%. You start with 100,000, like we said, you get to $188,000 and change. Now, what if you take the same returns while you're still working and you flip them? You get that good return up front, you get the bad return at the end. You can see down to the penny, you have the same dollar amount, starting with 100,000, ending with about 188,000. Bottom line is this: while you're still working, while you're still adding to a portfolio or just not taking out of a portfolio, the sequence of returns does not matter. However, there's a stark contrast to taking money out in the distribution phase or retirement. So now let's draw our attention to the 2 boxes on the right. You start retirement with a negative year, negative 15%. You're now taking $10,000 out per year. You can see that you run out of money somewhere between years 9 and year 10. Not good, right? However, you get a good return in that first year of retirement. The end of your 10th year, you still have over $52,000 left. The bottom line is this: for the 2 boxes on the right, the sequence of return really matters. So we see a lot of really, really good spreadsheets that people come in kicking the tires, and spreadsheets are really adequate to help you plan while you're still working. They're less efficient or less helpful for retirement planning. We think Monte Carlo simulation is the key. Show you going through retirement 1,000 times. We'll talk about that in a little more detail here in a minute. But kind of along the same lines, to kind of prove this point, let's say you were down 20%. So the overall stock market, the S&P 500, was down approximately 19% in 2022. Let's say you had all stocks in your first year of retirement, and you're down 20%, and you're taking out 4% from your investment portfolio. Well, you don't need 20% to get back to break even with this distribution, the money you're taking out. You actually need 36% just to get back to break even. And for a lot of people, what we've heard over the years is that's kind of alarming. That takes me by surprise. I didn't know it was such a high hurdle rate just to get back to where I started. And so a big part of our investment strategy, our investment process is, hey, let's win by not losing. Let's just not take the risk that we have taken historically to mute some of that downside, but also produce the necessary income for this number, the distribution rate, which also helps offset a lot of that downside volatility that no one likes, especially in retirement.
Investment risk number 4 is possibly one of the most egregious that we see when folks get to retirement, investing without a process. If you have a heart issue, you go to the clinic, the med center or whatever, they've got a process. They run these tests, they look at this, they follow a protocol of treatment, and there is a process to get you from where you weren't in good shape to back where you're in great physical shape. And so investing with a process is very important. Obviously, you have interest rates, you have the age that you retire at. We think a live well plan, as Matt has talked about, really gives us a focus or perspective on where you are, but we need income from the portfolio to make this happen. Now, what has happened historically is you see here that the industry tracks mutual fund inflows and outflows. And so let's change this to you go to Walmart or the grocery store and they have toilet paper or toothpaste on sale. What do? You would say, well, all things being the same, I'd like to buy it cheaper. So rather than maybe getting 1 carton of toothpaste, it's on sale, maybe you buy 2, or maybe you stock up and buy 3. Stocks and bonds are somewhat the same thing. This example shows that a lot of people sold stocks at the time when the S&P 500 index was lower. You can see that period there in 2002, 2003, and then that period in 2008. Stocks went on sale. There was worry about the economy. Yes, the great financial recession, if you will. Financial firm went bankrupt in 2008. Hey, it's going a lot lower. And actually, from peak to trough, the market was down almost 50%. So you were able to buy companies that were on sale, and yet this counterintuitive information led to an emotional response, and investors all over the country, I guess all over the world as well, sold stocks to pile into bonds because, again, of an emotional response. They didn't have a process. And so, again, we will make sure for all of our clients that we have a process in place, that you understand that process, and that we follow that process from start to finish, which again leads us back. If I understand what's going on, I've got clarity, comfort, and confidence. And again, what the title of the webinar, it's all about income. The next retirement risk is healthcare. One of the big mutual fund companies did a study, and the average couple will spend over $300,000. Wow, a lot of money. And you can make the case that this study really needs to be updated to be entirely accurate, given how inflation has really affected the service industry here recently in the last couple years. But it's very important for you to have not only income, but increasing income, as we've talked about, to offset the ravages of inflation.
So kind of a few maybe question marks surrounding your pending or current retirement. How do we face these uncertainties? We think the step number 1 is we create a retirement roadmap. We call this our Live Well plan. We've mentioned it a few times. A lot of people, what we have found out is they view retirement as a one-time event. I'm retiring on June 30th, 2024. I need to make sure I get everything taken care of beforehand. And they're not wrong, but they're not fully right. Retirement's an ongoing process and something that needs to be managed, what we think, more closely than what you've probably been used to in your working career. So we also think that if a plan's not written down, it's really not a plan. But the retirement roadmap, the Live Well plan, how much can you spend in retirement? How long will your money last? What rate of return do you need? We'll have a slide here in a minute on that. And how much income do you need to produce from your portfolio? Randy, sometimes he reminds me of an old Baptist pastor. He's looking for the 3 C's: comfort, confidence, and clarity. And we think that's really, like we said, what everyone is looking for in retirement. So step number 2, stress test your portfolio. This is part of the Live Well plan. How did what you're currently doing do in a 2008, 2009 scenario? How did your current investment stocks, bonds, mutual funds, whatever they are, how did they do in 2022? So we look at some historical down years and we plot how you're doing, how we think you should be allocated to reduce some of that mitigated risk. And sometimes you're allocated properly. A lot of times we see we need to make some adjustments typically for less risk, typically for more income. So that's kind of the quantitative side, the side that's maybe less numbers oriented. You know, emotionally, what does it look like? And we see people, and it almost happens overnight. People have a different emotional tolerance to volatility before retirement and after retirement. So that's another big key consideration as you do get closer to that retirement date.
So, go
Randy,
ahead.
Randy, take it away.
Okay, so Social Security can be very important as far as your planning is concerned. We are big advocates of looking at Social Security as one of the big investments, if you will, that doesn't show up on your balance sheet, because the Social Security is promising to pay you and your spouse for as long as you live, a lifetime annuity, if you will. Now, it's true that the inflation adjustments have been somewhat muted, but let's maximize what we can by understanding what we have and understand the options that we have. It's not just as simple as, well, I'm going to take it as soon as I can. System may run out of money, but married couples 80+ strategies, and so we have a special, if you will, portion of our planning devoted to looking at your Social Security. In many cases, especially if there is a spouse that's younger, we'll have the higher wage earner wait until later, because that will give more protection for the survivor's spouse. But all sorts of things, numerous marriages, divorce, widows, on taking Social Security. And again, your individual situation is different than your neighbor's Social Security situation. So we like to get a copy of your statement. And if it is in a real gray area, we've got a group of resident experts that we can bring in to give some more clarity, comfort, and confidence with regards to that decision. Promote income tax efficiencies. We've just passed the time of the year where we've paid Uncle Sam. We've settled up for a lot of people. Some are waiting until October if you filed an extension. But here's a couple ideas that will help you reduce your income tax. If you are 70 or older, you can do what we call a qualified charitable distribution from your IRA, and give money to a charity directly from your IRA. The charity does not have to pay income tax on that, and you do not get a deduction, but you get a backdoor deduction, if you will, by a reduction of the amount that the government requires you to take out. Idea number one. Idea number two, if you've bought a stock for $10 and that stock is at $50, there's $40 of gain. Don't sell that $50 stock, pay capital gains tax on the $40 gain. Take that share of stock that's worth $50, gift it to a charity. You still want to own the stock, take the $50 that you would have used to pay cash to your charitable gift and buy the share of stock back. But the charity is going to give you a tax write-off for $50, and the charity can sell the stock for $50 and not pay the gain. Bottom line, the taxable capital gain disappears. It sort of vanishes in thin air, and you have a leg up as far as cutting your income tax. That's gifting appreciated shares of stocks, bonds, mutual funds, real estate, etc. Then last, the higher standard deduction that we've got, and actually the lower property tax allowance. puts many of our clients, unless you're really making some large charitable gifts or have some unusual situation circumstances, more people than ever are using the standard deduction. If you do that, you might consider bunching up deductions to being able to itemize to get over that amount, paying your property taxes in December and then paying them again, paying them in January and then in December for 2 different years, bunching your charitable deductions, etc. Again, we can talk more about this, but it is something to discuss with your CPA as well on how to promote tax efficiency. So cash flow planning is probably one of the most important things that we do with a client, investing with the process. But how much can you take out of your account and still have a high degree of confidence that your money's going to last? Well, that's exactly what we think every person should look at. And that's where our Live Well plan comes into fruition. And we think that is very important. Planning is the cornerstone. It's the secret sauce. It's the foundation of what we do for our client family. But there's been studies over time that talk about you can take out 4%, ride the ups and downs and never run out of money. Well, interest rates are lower than they've been. So there's a title of a catchy article: is 3% the new 4%? Our interest rate's going to go higher, but the higher fixed income rates will help in the planning. But we think a combination of dividend paying stocks and some ballast in the tank through fixed income does make a lot of sense. You can look there and see the difference between taking 3, 4, 5%, the different colors on there, and money can disappear quicker. Again, if you have a downturn in the market, if you are sort of taking more than the law of large averages says you will do. So everything that we do for clients gets looked at through the lens of let's make sure the money lasts. And again, doing it 1,000 times to take into account that those different returns that we've talked about.
So we mentioned earlier inflation, that rule of 72. One of the ways we think is really something to seriously consider for your portfolio as you approach retirement or are currently retired, owning dividend paying stocks. And what we're looking at here, the gray bar is the total return, so growth plus dividends by decade, 40s, 50s, 60s, etc. The blue portion is what was contributed via dividend. And you can see it's a material number. So it over time it will change, but when stock returns are more muted, the dividends are a higher percentage. Given the fact that you will be needing income most likely from your investment portfolio, we think producing that income on the front end is something that all families should at least consider for their personal situation. Now, how have dividend stocks performed over time? You can see here from 1986 through the end of 22, they've actually outperformed the market. We take it a step further. We're not looking for only dividend paying stocks. We're looking for companies that have had a propensity to increase their dividends year over year. And that's really the key of how you fight inflation. Dividend stocks by themselves are not fighting inflation, but if you can find a company that not only pays a dividend, but can increase that dividend quicker than the inflation rate, that's how you combat inflation in retirement. So what we're doing is we're focusing on dividend growers opposed to just dividend payers. And there's a big difference there. You see the dividend growers in this page have outperformed the dividend payers, but disciplined income generation are the goals. We want to preserve the assets while generating the income you need to meet your objectives with confidence.
So long-term care is a subject that many clients ask us about. The average long-term care event is up. It has grown from about 3 to 3.5 years, which means there's a little bit more of a need for that. Some clients look at this from a standpoint of, I'm going to live in my primary residence. until I'm mid-80s, and then typically I'll transition out of the, if you will, the big house to a smaller house or some sort of facility, and that money will be my long-term care policy. Other clients are concerned basically on family history or their particular health history, and want to lay some of that risk off to an insurance company through a long-term care policy. Several companies out there that do this. You give the insurance company a lump sum of money. That money is liquid, and they provide a bucket of long-term care for you. So again, it's part of the planning process, something that we look at and should be addressed with regards to your particular family as you get closer to retirement. So step number 8, considering hiring an advisor without that sounding like a self-serving cause. We think we can make a case that at least consider that and kick the tires. Emotions really matter, and we see people have made some bad emotional decisions through the years. Mistakes are much more costly as you do approach or even get into retirement. Stress reduction, additional investment options, including alternative investments, individual bonds. But the average investor, it's interesting as you look at the 20-year annualized returns there. The average investor is down there at 2.9%, right above inflation. One of the major mutual fund companies did a study on this 1 year, and what they found is the average investor had not returned anywhere close to the average return of the fund. They tended to buy high. Things were looking good. Let's put some money in the fund, as opposed to the best time to invest was when things looked rather bleak, rather dark. The economy is not doing well, with an anticipation of the economy getting better. So again, interesting numbers here over this 20-year period. So in summary, again, we think the unique retirement planning process works very well. We think you need more than just an investment guy. My background, I came from a trust company where we did financial planning for Exxon, Shell, Whirlpool, Transco, Conoco, a lot of the major companies. And the companies realized that if the executive had his personal finances in order, he'd be able to spend a little bit more time with the company business. So we at the foundation are planners, retirement planning, investment planning, insurance planning, cash flow planning, estate planning, income tax planning. We call this holistic financial planning. And Benjamin Graham, who was a mentor to a guy that you've probably heard of, a guy named Warren Buffett, said, and we love this quote, the best way to measure your success is not by whether you're beating the market, but by whether you put in place a plan, and this second is key, a behavioral discipline that is likely to get you where you want to go. That's what we're all about. That's what we do. And again, we think this is an important, a critical thing to keep in mind as you approach retirement.
We mentioned it earlier, a big part of that Live Well plan is developing a family index number. This helps us answer the questions, what rate of return do we need in retirement? And how do I get there? There being the end of retirement, having the amount of money you want left with the least amount of risk. We said it earlier, we think we win by not losing in retirement. We're not trying to roll the dice and hit a bunch of triples or home runs in retirement. We think hitting a lot of singles, maybe a few doubles, is the way to look at investment returns during the golden years. So this is a key number that we do create inside the Live Well plan. So once again, comfort, clarity, and confidence. You can see here in this image, we give clients actually the keys to the castle where they can go in and make changes to their Live Well plan within their online portal. So you don't need Randy, myself, Maddie, to make all those changes. You go into your online portal as a client and you can play the what if game. What if I'm spending $120,000 a year opposed to $110,000? What if inflation's higher than we thought? What if investment returns are lower than we thought? You could come up with a couple thousand different scenarios in there. So we get a lot of good feedback on that tool, and I think hopefully has over the years helped provide clients that clarity, comfort, and confidence moving forward.
So if you're joining us on this webinar, again, we thank you, and you say, well, you know, it's interesting. Some of the information that you've presented makes a lot of sense. I'd like to think about interviewing an advisor. I've done this myself. You know, we ask the question, well, what if something happens to you? What during retirement, are you still willing to devote the same time and resources to doing that? But a couple ideas if you do decide to interview an advisor. Number one, does that advisor follow a fiduciary standard? They're going to represent you or the firm that they work for? Do they have a transparent cost structure? Sounds simple, but in true life, it is not so. Experience matters, whether you're a brain surgeon, whether you're a dentist, or whether you're in the financial services industry. We think that the certified financial designation is critical. We also are certified investment management analysts, and again, we have a firm that has a succession plan and is a team effort. Do you have an individual or team supporting you? If you have heart problems, you don't want someone that does gallbladders on Monday, big toes on Tuesday, and then gets around to hearts on Wednesday. If someone calls, you want someone that does hearts on Monday, Tuesday, Wednesday, Thursday, Friday, and if needed, Saturday or Sunday. That's all they do. That's their specialty. They see it morning, they see it at noon, they see it at night, and they study it, they go to conferences, and they are all about hearts. Well, we're all about retirement. You matter. Personalized retirement strategy. We see people all the time that have some sort of a basic investment strategy or philosophy that's being implemented for 27-year-olds and 67-year-olds, and it's just a one size fit all. Every client, I'm happy to report, has a personalized retirement planning and strategy, not cookie cutter, low client to advisor ratio. As Matt has talked about, we think we are Phi Beta Kappa as far as communication. We want to speak in a manner that communicates well, not using industry buzzwords. You have a written holistic plan that is workable, doable, and you can change. We want to anticipate your needs, and we are famous for systematic outbound communication, as Matt said, especially in times of stress. So if you want to shoot us an email, we have a complimentary guide there on 10 questions to ask your financial advisors. But happy to report the trains ran on time. We appreciate each of you for joining us.
Randy, one question here just popped in. What characteristics of a company make it a dividend grower opposed to just a dividend payer? And we're looking at historic dividend growth metrics. So we're not necessarily looking for a high dividend payer. We're looking at someone who has continued to increase that dividend year over year. Another term for this could be a dividend aristocrats. A lot of these companies are what we call value companies, and that's good and fine. Typically, when we look back over the past 10, 15 years, value companies don't always rise as the market rises. So we do think it's important to have some growth dividend increasers as well, or some companies that pay dividends that are more growth oriented. So not necessarily the overall dividend, but historically how the company has increased that dividend year over year.
And that growing dividend helps us combat one of the major things that could hurt a family during retirement, and that is inflation. I hear all the time about, well, have you been to the grocery store lately, Randy? You know what a carton of eggs cost? And I go to the grocery store, and I do know that. And so things do cost more, and that dividend growth will allow you to compensate to keep up. And so hopefully the return on the stocks as well as the dividend income will offset inflation during your retirement and allow you to continue the standard of living in which you become accustomed to. So again, feel free to reach out with questions or comments. Information there for myself, Matt, Maddie Kearns. the team picture, Tiffany, Matt, Randy, Maddie, and Melissa. We're here for you, and utilize that resource. No cost or obligation to reach out. We tell folks, we sit down all the time with them. If there is common ground, we'll both know it. And if not, we'll shake hands, part as friends, and you will leave as a better equipped potential retiree to be. So again, thanks for your time. Have a great rest of your Thursday morning, and hope to see you next time right here with the Price Group on one of our educational webinars.